18. Yep.
Awesome.
All right, we're good. Go for it.
Perfect. Well, hey, everybody. Sorry for that technical difficulties. As Jason said, this is a new platform, as you guys are well aware. It's a little bit more high quality, technical. Ask Jason if you want to know about it. I don't know anything. So, regardless of that, we want to just welcome everybody once again to our Q1 2023, macro quarterly call here. As always, we're going to be starting here with John. He's going to kind of go over where we've been, what we're seeing in the data, and what to expect in your accounts. And then Jason's going to do that deeper dive, into the data. We have a couple slides here that we want to share just to ideally paint a picture for each and every one of you to see what we are currently seeing and what we have to, really be investing around each and every day for you. So with that being said, I'll just turn it over to John. But in the meantime, if anything does come on up with questions, throw it in the chat box. I'll be working that, or we'll get those questions answered at the end as well. So take it away there, John.
All right. You guys are blurry. Am I blurry?
That's all right. The system will fix it, John.
Okay.
You'll be fine.
Okay. All right. So let's start with the last quarter, what happened, maybe recap last year. Like Michael said, then I'll move into and talk about kind of the current positioning and what we're seeing, and then venture out into the future and kind of tell you what we're looking at, what we're worried about, what we're excited about, and so on. So in the last quarter, a couple things of note. First of all, Jason and I attended the Hedgeye Live conference in Dallas, November 10th. Michael and I did that in LA a couple of months prior to that. Once again, it was a really good use of time. We learned a lot, got to meet all the key individuals in that firm, and came back even more, impressed with their process and their research and the caliber of individuals at that firm. We also, a week and a half ago, were on I don't know if it was a national podcast, but it had a fairly large viewership. A fellow by the name of Pete Santilli. It's his podcast. We sent you out a link if you care to look at it. We basically discussed crypto and the collapse of the whole crypto infrastructure. Jason did an outstanding job on that. I just did a lot of nodding. But it was, if you got a few minutes, well, actually, it's about an hour. If you're interested, take a look at that. We're supposed to be on that same show in about a week and a half, I think. So we'll send you out the link if and when we do it. And it sounds like, we may be on some national ones as well. So we'll keep you up to date if we do any of those. So let's step back and look at last year. Last year we were down plus or minus 8%. New clients fared a lot better than that because unfortunately most of our losses occurred last January. If some of you remember, we went into January last year fully invested with about 50 or 60 positions. And by the 7th or 8th of January, we had flipped because the data told us that we were headed for what's called a quad four, which effectively is a recession / bear market. And so that first week in January, we quickly pivoted from a full-blown aggressive investment to a massively defensive position. However, we did lose about 5.5% in that month. And that's what we keep telling you is the pivots is where we lose, our money. When we go from one investment regime to the next, you can expect us to lose about 3 to 5%, and then we'll make it up. So if you're new to us and you came after February, you were maybe either up for the year or maybe down 1 or 2%. If you were with us the full year, down 8%. How does that compare? S&P last year was down close to 20%. The NASDAQ was down 33%. The Russell, which is a small cap index, was down close to 22%. Believe it or not, long U.S. government bonds were down close to 30% on the year. Emerging markets down 18%. If you happen to own Bitcoin, you were down 65%. Europe, 16% down. Corporate bonds were down 18%, but the weird thing was high yield corporate debt was only down 9.9%. So as you're going to see when I talk about positioning, we're heavily short these things because they should not only be down 9%, they should be down probably 30 or 40%. Commodities were really one of the few things that were up last year. They were up 24%. Most of that was oil. So if you were in oil, okay, you had a good year if that's all you had, which that's not how you invest money, but that was an up sector. Inflation ran at an average of 6.5% last year. Cash earned 1.82% last year. REITs were down 26%. Gold was down less than 1% last year. And if you happen to be in a Wall Street firm where they love 60-40 allocation, 60% equity, 40% bonds, that gift allowed you to lose 22% of your net worth. So how does that compare? Obviously, 8 is a heck of a lot better than what I just went through. So last year was effectively one of the worst investment years, period. It was very, very difficult to make money anywhere, right? Unless you had a lot of cash, unless you had some oil, unless you were really short the market, you had a crappy year. Let's see. So what happened in December? Actually, in December, we had a really good month. December, the market was down close to 6%, and we were actually up 1%. So we outperformed literally by 7% just in December. Markets behave the way you're seeing, with the volatility you're seeing. This only happens in a bear market, guys. So these big moves up and down, that gets everybody excited. A lot of it's just noise. It's what happens in a bear market. So that was kind of the past. Where are we in terms of current positioning? So if you look at your accounts right now, you'll notice that you have approximately 15% in gold, silver, platinum, and gold, silver miners. That 15% is actually less than where we were even about a week or two ago. We were over 22, 23% of the time. So we brought it down because those things have been on fire. They've been one of the hottest places to be in the last 5-6 weeks. So we took some of our gains, and as of the close today, we started adding back to a little bit of gold, a little bit of silver. You're short, or we're short, approximately 27% of the portfolio. That's huge for us. That's the reason why today, with a market down 600 plus points, 1.5%, we were actually up 1/4 to 0.5% today, depending on what account we're looking at. So you have 27% short the S&P, the NASDAQ, the Russell, Bitcoin, high-yield bonds, Europe, the euro, all sorts of things. Cash and treasuries make up 40% of your accounts. We're net long about 9-10%, and we added some of the close today, so that's probably a little higher. And you have about 11% in the U.S. dollar. So that's a current allocation. This is a bear market allocation. This is not how you invest if you think, the future's rosy and we're just going straight up. An important thing to note is that your 2-10-year spread, so the spread between, so if you look at 2-year U.S. government bonds and 10-year government bonds, and you look at their yields and you subtract them, you're at what's called a negative 0.71 inversion. What does that mean? That means your short-term bonds are having a higher interest rate than your long-term 10-year bonds. That only happens when the market is expecting a severe recession. This 0.71 is about as extreme as we've ever seen. So the market's telling you, at least the bond market is, that there's no question we're in recession. If we were to walk in tomorrow with this current allocation that we have and the market drops 10%, there's a good chance we'd be up anywhere from 3 to 5%, depending on how gold does and the dollar does. But we'd make money. And that's what we're not anticipating a crash, but it could happen. So what you're seeing a lot of, and a lot of the crap, frankly, we've had to deal with, is a lot of manipulation by options traders. There's 3 main options traders: Susquehanna, of course, Goldman, and I think the third is Citadel. I'm not sure. Anyway, these major option dealers are playing very interesting games with very short-term dated option. What they're doing is they're buying calls, which means that it's a bullish bet on the S&P 500, let's say at the 4,000 level. So these guys are coming in and massively piling into these calls and creating an environment. And these calls mature within 7 hours. That's how stupid this is. They're coming in, they're buying these calls. All of a sudden, all the players are looking at it and saying, holy crap, something very, very bullish is going on. because all these calls are being bought in short order. So what they have to do to hedge is they have to sell volatility. That's the VIX. They sell volatility, that VIX number comes down, and then what happens is the algos see that and say, oh, wait a minute, the volatility indicators went from 24 down to 18. This is a bull market. I got to go buy. So a week and a half ago, when you saw the market up 700 points, the Dow, or even this week, a couple of days, we had really up days. Those are the gamma, it's called a gamma squeeze. That's the game that's being played. So you guys send us texts or emails saying, what's going on? Are we missing this, bull market? What am I missing? You're missing nothing. You're missing market manipulation. Our job is to not get sucked into those kind of trades, because you know what happens? Days like today. That gamma squeeze ended this morning at the open, right? Market was up, VIX was down, right? Everybody got excited, and then bang, the minute they're done, they pull their bids, they're gone, market flushes straight down. So don't get carried away with all of this volatility thinking it means something. A lot of times it means nothing, and all it really does gives us an opportunity to short like crazy, like we did yesterday, the day before, and so on. So that days like today, we get paid. And then what do? Now we start closing off some of our shorts, and we go long some of our long exposure. As long as the VIX isn't in what we call the F bucket, the uninvestable bucket. So that's the zero dated, or the zero days to expiration. Zero DTE is the term that's being used in the industry. Markets have been manipulated forever. So this is nothing new. It's just like incredibly egregious, in your face. And thank God we know how they're doing it, so that we can manage money accordingly and avoid becoming a victim of their manipulation. All right. I just need to explain that, because we're getting a lot of texts, emails about people worried that we're missing the next bull run and this and that. Like, no, are you kidding me? The worst of the bear market is actually right here now. All right. So it's still quad 4 globally. Quad 4 is effectively when markets are dogs. Okay. They're horrible. China's the only real major economy that's transitioning to something less severe than a quad 4. Hence the reason you're starting to see some exposure in your accounts as of today. Okay, so the recession trade is over. That ended last year. What we're focused on is a much scarier scenario, which is the recession trade. Recession trades are very different than inflation trades, right? So now the economy is starting to slow at the fastest rate of change since the beginning of this last January. We're now entering a U.S. corporate profit recession, right? So profits are declining big time, just starting, but they're accelerating to the downside in quick order. Margins are doing the same thing. Revenues are doing the same thing. Okay, so that's effectively what you see in a quad 4. Eventually, this is going to morph into a credit event. A credit event is where the Federal Reserve panics. A credit event is when corporations can't borrow. A credit event is when your money markets start to, seize up a little bit, right? We're headed straight into that environment. So if we're right, within the next 6 months, we will see some carnage in the bond markets. We will see carnage in equity markets and so on. All right. So now let's talk about the future, since I kind of already headed that way. So phase 3, this bear market is a recession trade. It's the worst phase. It's where, if you thought last year was kind of nasty, which it obviously was massively nasty, the real wealth destruction occurs right here now. If we're right and this thing bottoms in the next 6 or so months, call it 6 to 9 months, 3 to 6 months, we don't know for sure, obviously. The amount of destruction of wealth between now and then is going to be eye-opening. Especially if we have a real serious credit event. At some point, this thing will bottom. Like I said, maybe this year, but frankly, the back of my head, I keep wondering if this thing will even continue into next year. This bubble is so massive, it encompasses everything, and the unwinding has been fought so hard that it's like, Chinese water torture. It's like, okay, come on, let's get with it. So my guess, if this thing doesn't really open to the downside real soon, like first 6 months this year, we'll be dealing with this kind of similar setup potentially into next year. All right. Crash risk is high, like I mentioned. Here's one of the things that we really worry about. So we have an inflation problem, and we have way too much debt in the system. If the Federal Reserve doesn't stay to their guns and continue to force this economy into recession, continue to effectively create a deflationary environment that will take down inflation, right? If they don't continue to do that and deal with a seriously lower stock market, issues with credit, issues with the economy and recession, if they don't panic when all those things start to happen, I think we'll be fine. It'll be brutal. It'll be a brutal 6 to 9 months. It'll be a horrible recession, whatever. But the Fed needs that pain and suffering and recession to get ahead of this inflation problem. If he doesn't do that and does what Volcker did, in the 70s, Volcker, people don't understand, he actually he pivoted too early. He got scared and pivoted and stopped raising rates and whatnot. And as a result, over that decade, it was a horrific decade with 3 recessions until he finally got religion and said, to hell with it. We're raising rates of 15%. We're going to tank the economy. And finally, we got past the inflation problem. So if Powell, sticks to his guns and continues to do what he's doing, I think we'll be okay after some really, really severe pain. If he panics because there's a credit event, companies are freaking out. He's getting calls from, Biden, if he knows how to run a phone. Anyway, if he pivots too early, then we're nervous because, we'll have a huge rally. Everybody will get excited. But now inflation will come roaring back. And now we're setting ourselves up for a potential scenario like we saw with Volcker. So we hope that's not going to happen. Couple more things. Watch Japan. Japan's losing control of their bond market. Last night, I watched their currency move 2.5% in literally a few seconds. So they're trying to manage their interest rates. That's the problem we're trying to avoid by keeping our rates high and starting quantitative tightening. The Japanese have printed money for so long and kept their interest rates to zero that the bond markets are now saying, hey, you got an inflation problem and we're going to start raising rates on you. So last week alone, they printed $75 billion to buy their bonds to try to keep interest rates between their band of 0.25 and 0.5. So we're watching Japan real closely because if they really do lose control, well, then it gets very interesting everywhere because that'll be a big deal. Gold is probably entering a multi-year bull market. For those of you who've been with me for 20, 30 years, I like that a lot. It's a good place to make money. So if you ask me, where do you think you're going to make a lot of money this year? I think we can make a lot of money in gold. I think our shorts, we're getting more aggressive on the shorts because we think that the real bear market is here right now this year. So we're aggressively shorting more. Bonds, actually, as of today, we may start buying bonds like in the next few weeks. That market, we can put a lot of capital in bonds. Last year, we lost money in January, and then we got into bonds twice because they should work in quad 4, and that cost us the other 1 or 2 or 3% from last year. This year, hopefully, we can get in and not mess up the timing and really pile in. So that's that. Our key focus is going to be on the recession and credit events and how that impacts markets. So expect revenues to start declining for corporations, margins to start declining, profits to start tanking, and unemployment to really start picking up. A couple last things. In 2002, the last time we had a similar setup like today, the NASDAQ rallied greater than 10% 11 times during those 3 years. 4 of those times, the market went up 28 to 50%. That's how bear markets behave, right? Even Warren Buffett at one point said, the bear market's over, time to buy. And he went in with billions and bought stuff, and then the market dropped another 40%. So even Mr. Buffett, screwed up. So that's why we're very leery about head fakes and trying to time this thing right. M2, which is the money supply, is contracting. That hasn't happened since the 1960s. That is critical. If M2 continues to collapse like this, shit's going to break everywhere. That's like, taking the oxygen out of your room. Eventually you'll die. And basically that's it. This is what we call the washout phase. This is where people give up. And I know it's not what you're seeing in the markets, I guess, up until today, but it's here. And the last thing I want to say is, one of the best things that happened last year is the three of us learned how to short. That's a new skill that we didn't have prior. Really, we didn't have it as well as we do today. But shorting is a totally different investment game. And I think we've mastered it, or mastered it. I mean, I think we've gotten really good at it. So that was good last year. We learned how to short, and it's actually, frankly, a little more fun than going long. So anyway, I digress. Jason's all you.
Great. Michael, can you slap those slides up there, and I'll go through them?
Yeah. You guys see the slides?
Yeah.
Just about. All right, cool. So I always like to show this. These are our quads, and we always talk about the quads, but this is what they mean. In the upper left-hand quadrant, you have quad one. Quad one is with growth accelerating and inflation decelerating. Quad two, which is in the upper right, is really when both are accelerating, growth and inflation. Quad three in the lower right-hand quadrant are when growth is decelerating, inflation is accelerating. And quad four, which is what we're currently in, both growth and inflation are decelerating. What I want you to take note of is where we are on this map. What you'll notice is the first quarter of 23 falls firmly into the fourth quadrant, along with the second quarter of 23. And then you have in the upper left-hand quadrant, which is quad one, you're seeing a third quarter of 23 dip into that quad. Now, the probabilities are the probabilities are pointing to a quad one in the third quarter. Obviously, that can change, but right now, that's where the probabilities are kind of sniffing out. Fourth quarter, we dip back into quad four. So you have a quad one sandwiched in between quad fours. And so, as John had kind of mentioned, we have to be very careful and we have to watch these probabilities change as we get closer to the third quarter and whether we really are going to get a quad one. So that's the map on where we're going based on data. Michael, next slide.
Yep.
This is U.S. real GDP year-over-year projections. What you'll notice is that we had our second quarter of 2021 were the heights of GDP on a year-over-year basis, and we're stair-stepping down to the right. And so what you'll notice is that in the fourth quarter of 2022 into the first quarter of 23, we're getting some very low growth numbers, and we have decelerated really through the third quarter into the almost the entirety of 23. So growth is decelerating. Now that's half of what quad four encompasses. The next slide will show us the other half. And this is CPI. In other words, it's the measure for inflation. In the second quarter of 2022, we were at our heights of inflation, and now we're stair-stepping down. Now, even though we're stair-stepping down and decelerating, what you'll notice is we are still very, very elevated. If you look on the left-hand side of the screen, what you're going to notice is that the norm is typically around 2% inflation. We are 3 times plus that, even at this elevated state. And so even though we're decelerating, which you'll notice in the fourth quarter of 2022 into the first quarter of 23, all the way down to the third quarter of 23, what I want you to take note of is we are still elevated. We have sticky high inflation, and that inflation is going to stay up there for quite some time. And that is part and parcel of the reason why the Federal Reserve is so aggressive in trying to get these inflation numbers down. So this is the other side of our quad four data set. You have CPI or inflation decelerating along with growth or GDP decelerating. Next slide, Michael. What I want you to take from this, because this is very dense as far as data is concerned, but I just want you to take note of these colors. This is the G20 GIP model. We measure and map 50 countries throughout the world with the same data metrics that we use in the United States. And what I want you to take note of is the first quarter of 23 and the second quarter of 23, and right under the estimates on the left-hand side, not the actual, but the estimates. And what I want you to take note of is how much red you see going down those columns. 83% of the world is going into a quad 4 in the next 2 quarters and are already in a quad 4. The one little bit of green that you see in the second quarter of 23 is China. Now, we've taken some nibbles at China. We don't know if that's the direction we're going to go, but certainly our probability and our data set is telling us to go that direction. I know everybody's not thrilled with China and, you're not the biggest fan, but if we can make money in it in some way, shape, or form, you better believe we're going to try to do our best to do that. So take note, just know that it's not just a United States recession and bear market, it's a world recession. These are our macro themes. And so as John had mentioned, we have a US profit recession. Inflation was last year's battle. This year, we have a quad, we are in a quad 4. We have higher rates for longer or sticky high inflation. We have further negative acceleration in profit growth, which I will show you in the next slides. And we are going to have the largest liquidity contraction in a century, which will be very unkind to markets and credit markets. And so when liquidity gets pushed out of the market, that is a dangerous thing. And we'll go through why. Long gold and precious metals and miners. The reason I want to bring this up is, as John said, gold's kind of a flight to safety. Its appeal is most pronounced in quad 4 environment, which also historically corresponds to declining real rates, which we are seeing. It's a backward looking, the Fed is backward looking, and they're looking into a quad 4 slowdown. They're raising rates at a sweltering pace. It's breaking stuff all over the U.S. economy. It'll inevitably conclude in a reversal of liquidity taps. And so this is what gold has been sniffing out and why we are going into precious metals, not only gold and silver, but the miners, which represent a higher beta play on gold. And then by China, I'm not going to go too far into this, but what I want you to understand, go back one more, Michael. I just want to go through one thing. What I want you to understand is that when we're looking at China, China typically has tended to run a quarter ahead of the broader G20. So as you'll notice from our quad environment, even though China's going into a quad 1 in quarter 2, we might be going into a quad 1 in quarter 3. Thus, they kind of run a little bit faster than a lot of the broader G20. Go ahead, Mike. This is an interesting one. It's easy to read. This is global equity and bond market total market cap drawdown from the peak. Equities, the peak was November of 2021. We have $45 trillion of market cap destruction from the peak. Go ahead, Michael. This is the Goldman Sachs Unprofitable Tech basket. Goldman Sachs creates this basket of securities of tech that is unprofitable. And what you'll notice is we've had a 77% drawdown from the highs to the lows. And let's not, the reason a lot of these companies even are in existence is from a decade plus of easy monetary policy. These companies would never be able to operate in any other environment, because when you have cheap money, it's easy to get loans. It's easy to keep your business going. When you extract money from the economy and it's more expensive to get a loan, how are these guys going to pay for it? Let alone they have really terrible credit and they probably can't get the loans because the policies that the banks are now implementing are so much stricter. So this might be the most destructive environment for any of these, what I'll call zombie companies, you're going to see more companies go to zero than you've ever seen in your entire life. I could name 5 off the bat that are going to zero, and there's going to be many, many more. So this is just to show you what kind of destruction, at least in the unprofitable tech category, has occurred. This is a good one. So this destruction hasn't only happened in the small cap, unprofitable tech world. It's also occurred in the bubble caps, the things that everybody is invested in. Google, Amazon, Apple. Google lost $838 billion in market cap after a 61% crash. Amazon lost $999 billion after a 54% crash. And Apple lost $997 billion in market cap after a 41% crash. So this environment has not been easy, even for the large cap profitable companies out there. Next. As John had mentioned, the one thing Powell doesn't want to do is pivot too early. We've noticed this a number of times over the course of the decades. We've had early pivots. So Powell believes, the Fed believes, that they're kind of in this downward trajectory from inflation, that we're rolling over and we're coming down the mountain and they're going at the right pace and they see inflation decelerating. The reason that they don't want to put on the brakes, part of the reason why they're going to keep interest rates higher for longer, and in fact, most likely they're going to keep things moving by 25 basis points through May, is because they don't want to turn around, pivot, and look at what happens to the right side of this chart. This is what happens. If you pivot too early, inflation's going to run out of control, and you're going to have even more aggressive interest rate hikes from there. That's going to completely destroy the U.S. economy. At least right now, we're doing it at a pace that unfortunately is the fastest pace ever, but he's on the right path. Next one. So this is just not fundamental pivot fodder yet. And what I mean by that is, as we showed, CPI is still elevated. It's not coming down very drastically. And so when you have CPI at elevated levels and median CPI at elevated levels, the fact of the matter is you have inflationary pressure that's persisting. And it's not, in order to alleviate that inflationary pressure, the Fed is going to have to keep rates higher for longer. Hey, Dr. Pensack, can you mute your computer for me, buddy? Thank you. Next. So we have a lot of work to do. The imbalances driving elevated wage inflation have not rebalanced. All I want you to take from this is that obviously the policy beatings will continue until payroll capitulates. The last thing to go underwater is employment, and the last thing along with payrolls. So as you'll notice, we still have not many available workers per job opening, right? And then you have job switchers versus job stayers. You still have wage growth that is pretty outsized because all these companies are trying to get more employees to hire, but it's tough to do. And so you still have these wage payrolls high. You still have unemployment low. I'll explain why unemployment data is low, but you have to realize one thing. Employment numbers are a lagging indicator. If you go on CNBC and you see Jim Cramer, who's an absolute clown, yelling about everything related to unemployment being low, yeah, it's low. It's a lagging indicator. Give it another 9 months. It's going to be absolute destruction, and it's a really sad thing to see, but that's what's going to happen. And that's the last kind of brick to fall. Next. As John had mentioned, this is an M2 money supply year-over-year data set. Let me explain what M2 money supply is. M2 is the U.S. Federal Reserve's estimate of the total money supply, including all the cash people on hand, plus all the money deposited in their checking accounts or their savings accounts, and other short-term saving vehicles such as CDs. This is what makes it's the grease that allows the wheels of the economy to turn. And when you extract liquidity from the markets, the contraction and the spendable credit declines. And let's just take discretionary things that people purchase. If people aren't purchasing those things because they don't have the liquidity to do that, what's going to happen to the pricing of those things? So what you're noticing is since 1960, this data set goes back to, we have the first year-over-year percentage loss or decrease, I should say, in M2 money supply. That is scary, and that is exactly why credit markets, part of the reason credit markets are going to lock up. Next. All right, this is another thing John talked about, but it gives you a little understanding of what we mean by volatility. On the left-hand side, you're going to see on the darker line, that darker black line, is the volatility of the MOVE index, or the MOVE index, I should say. MOVE index is the volatility of the bond market. It's just a measure of what the volatility is in the bond market. The lower half, that gray line, shows the volatility, or the VIX index, which is the volatility of the S&P. The amount of discrepancy between the two is insane. And the reason it's insane is on the right-hand side, the percentage of days with the VIX down and the S&P down. This is the bullshit game that's being played in the market. And in the options market, what's occurring is that all these large, like John said, Citadel, Goldman, all these market makers, there's billions and billions and billions of dollars that are purchasing calls. And when you purchase calls, those calls alleviate the volatility index. They bring the volatility index down. And at that point in time, people think it's safe to invest. They're tricking the market into thinking that there's nothing wrong. And they've done this all year. And look at the size of the percentage of days when the VIX is down and the S&P is down. Something is screwy. And that's the game being played. Because what typically happens is the VIX goes up and the S&P goes down. It's inversely correlated. Right now, there's a lot of days that they're correlated. And so people are confused. They're pissed off. They don't know which way is up from down. And so that's why last year it was such a roller coaster ride. Part of the reason was that they were playing games in the option market, with which thus they were playing games in the VIX market. So 20% of the days of all days in the last year have been days with the VIX down and the S&P down. Next. Meanwhile, on Main Street, real earnings growth, 20 months, year over year negative growth. Real wage growth means when nominal rate wages rise slower than the rate of inflation. Okay. And so even though people might be getting paid more, they're not keeping up with inflation. So you have real earnings growth that's negative. The struggles are real. I just want to be clear about this. If you watch CNBC and you watch any other clown network on TV, Bloomberg, you're going to hear a lot of people say the consumer is healthy. That is beyond bullshit. That is not true. The consumer is getting absolutely massacred. And this goes from all adults. We're talking Gen Z, millennials, baby boomers are the least of the worry, but we're talking about 40%, more than 40% are regularly running out of money and have to rely on credit cards or family to take care of basic necessities. More than 40% of Gen X, almost 40% of millennials have less than $500 in emergency savings. This is bad. And I'll go on to show you in the next slide how bad this is. Go ahead, Michael. Next. So the consumer squeeze continues to intensify. Yeah, we're good. The consumer squeeze continues to intensify. So credit card balances grew at the fastest rate in the last 2 decades. As you'll notice on the left-hand side, on a year-over-year basis, credit card debt's gone through the roof. In addition to that, on the right-hand side, people are taking on more and more debt at the exact wrong time. We're at multi-decade credit card interest rate highs. So people, if they're unable, you can easily just go to the grocery store and buy eggs or buy orange juice or buy chicken or buy meat. And everybody knows if they have a family, how expensive that is. And just basic necessities, people are having to put this on a credit card because they can't keep up with inflation. They're not getting paid enough and they're having to put it on credit cards. The interest rate is high. And just think of how that kind of barrel rolls. The majority of the next month, the majority of their payrolls goes to paying down whatever interest they have on the debt, trying their best to get the principal down, but then they're out of money and then they have to go spend money on the stuff that they need. And it's just a kind of a bad scenario. So this kind of gets to the point. Next, Michael. The tank is getting empty. Personal savings rate, obviously, if credit card debt's going up and interest rates are going up, people have less money to save. On the left-hand side, you'll notice that we're at multi-decade lows. U.S. bank deposits, in addition, are going down drastically. We're in negative territory. We were at 350 billion. Now 350 million. Now we're at, I don't know, what is that? 200 million. So deposits are going down. Personal savings are going down. No, it's not good. Next. So this is a labor report. And the biggest thing that we noticed, or at least I noticed, is that the NFP payroll report had this weird divergence from household surveys. And so NFP report comes out of the government and they're saying that they created all these jobs. Biden comes out and said we created the most jobs they've ever seen. That's a complete load. How they do that is the NFP report comes out, and what you'll notice is full-time employment, that red line, and I know it's really small, but the left-hand side, you're going to notice full-time employment has plummeted. But what's increased is part-time and multi-job holders. So NFP counts multi-job holders as multiple job openings, whereas the household does not. They only count the one person one time, even though they hold 3 jobs. So this NFP data set is wrong. And what's going to occur is as they go through the next however many months, they're going to revise that to come more in line with the household surveys because they know this is a figment of their imagination. They're making it sound like it's great. And this is part of the reason why they're pulling the wool over your eyes, is they're saying, oh, the consumer's great. We got this low unemployment and this and that. And that's not what's happening. People are losing their full-time jobs and have to take multiple jobs, and the NFP report's counting them multiple times. So that's all BS. Next. Labor, small business employment has really been crushed, which is sad to see. The number of tech small business employment that's the biggest employment center in the United States. So seeing that go negative is very disheartening. Number of tech employees let go. You can see at the end of last year in November is when the majority, Amazon, Twitter, Meta, they all let go over 60, in aggregate, over 60,000 employees. And it's actually going to keep at that pace. I think Microsoft laid off 5,000 people today. So January is not going to get any better, and it's probably going to barrel roll from there. Next. Labor cracks are widening. And basically what I want you to see is that, temp help employment has been negative for 4 consecutive months, and overtime hours are now approaching recessionary levels. So the month over month change is pretty drastic. Overtime hours, it's going to keep going down. And this is, like I said, employment's kind of the last thing to fall, and it's going to fall this year. It's really kind of a balancing act on when that's going to occur. But it looks like it's starting to break down pretty significantly, as John had mentioned. Next. This is related to the wealthy families, individuals, and how this affects now the luxury side of things. On the left-hand side, what you're going to notice is the luxury home sales have really cratered to a record rate of change low of negative 30 8.1% year over year in the latest month. Meanwhile, the high ticket items like boats, aircraft, jewelry, watches, they're down negative 7.4% year over year. So this is now hitting the wealthy. But the one thing you have to realize is that, yes, the wealthy have savings, but if the wealthy are seeing the same thing that everybody else is, they're not going to use that savings to buy indiscriminately anymore. They're not going to buy discretionary asset or discretionary things like boats and aircraft and jewelry and watches. And you probably have seen us go short in a number of names like the ticker symbol HZO or ONEW. That's a play on the luxury goods market. And those are things that we're shorting because we're seeing such catastrophic destruction in the luxury side of things. Next. Pike formation, almost done, guys. Capbacks. So more broadly and simply, if investors remain, let's say, if inventories remain elevated and demand is slowing and the cost of capital is at decade highs, do you think any company is going to go out and spend more money on capital expenditures? Not a chance. So this is going to start to roll over pretty significantly as well, especially with margin compression and profitability recessions. Next. Housing. Builder confidence has already declined at the fastest pace ever. And for the record, it's been 12 consecutive months, while signed contract activity fell at the fastest pace ever in the latest November data. Buyer traffic cratered. Pending home sales cratered. I think there was something out today. I don't know. It was a large home builder that said, I think it was KB Homes that said they had 38% of pending home sales canceled. So people aren't buying these newly built homes at this point in time. Michael, go ahead. Few more slides. Commercial and industrial lending. The lending standards are getting very, very tight. Liquidity is contracting. High yield spreads are probably going to blast off through the roof. When you have commercial and industrial lending have tighter standards and increased rates, so the cost of capital is higher. As I mentioned, these zombie companies or these companies with no profitability, they're going to have some serious problems. Next. And then last, just to harp on this, when these zombie companies and these companies that don't have any profitability finally cry uncle because they do not fit the more stringent standards of the banks, they're gonna default, and charge-offs are going to go up and distressed supply is going to go up. Next. One slide to show VCs. What you're going to notice is Series D valuation, Series C valuation, they have absolutely been eviscerated. So eventually VCs are going to have to mark to market their individual holdings in their fund. And this is most likely going to continue throughout 2023. So this is a tough one. You know, people that have VC investments, this is going to be one that's hard to swallow as they see those returns come in when they have to mark to market. Next.
The same problem applies to private equity, Jason.
Yes, absolutely. Absolutely.
So all of you that have these private equity and venture capital funds thinking that you survived last year and you'll be fine, in the next 3 to 4 months, they're going to be given marks to mark, which is going to be reality. And so you're going to go from being at 100,000 to 70,000 in one statement. And you're going to be like, whoa, what happened? You know, they don't have to mark to mark. They're illiquid, so they can wait. And that's what they're doing. And then you get shocked all at once.
This is just to reiterate John's point, is that there is going to be a profit reckoning throughout the S&P. The Russell with the small cap has been eviscerated. This is phase 3. And the blue bars on the right-hand side, those are trailing 12-month earnings. those blue bars are going to flip as they revise through the next 12 months. So they're going to go negative, and they're going to go negative in a drastic way. And that's where we see this phase 3 playing out. It's not inflation anymore. It's recession. And recession is going to occur through every vehicle, investment vehicle that's out there. And so there might be some that'll be fine, but the majority of things are going to take it to the chin. And so we have to be, but it's an opportunity. It's a really good opportunity for companies that we know are going to go to zero, or companies that we know are unprofitable. So that is all I had. Thought I was going to get by a little bit quicker, but are there any questions, Michael, that John and I or you can answer?
Yeah, so we actually have a couple here in the chat. So once again, you guys, top right-hand corner, chat box, go ahead and throw in your answers or your questions, and we'll answer them. I did get one from one of my clients here, so we'll start with that. So are we pleased with our 2022 performance?
I'll give you a break, Jason. Are we pleased? No. And well, yes and no. So no, because we lost money. So anytime you lose money, how can you be happy, right? Now, when we talk to people in the industry, when we see what's going on, we had an incredibly good year, right? I mean, being down 8 when the market's down almost 20 or 30 or 40, depending on what markets you're looking at. Yeah, we came out of this incredibly well, and we did we've never worked as hard to lose money in our lives. Ironically, I mean, that's what we did. But when you're down 8%, you need 8% to break even. When you're down 30, what do you need? You need about 42% to break even. Big difference. So this 8% that we're down, yeah, it upsets me or us. But it's nothing. I mean, we can make that up in gold, literally, gold alone in the next 6 months, right? So I'm excited about this year because now we have opportunities to deploy capital and we're not totally defensive. But yeah, last year, yeah, we did really. I mean, we have buddies in the industry that are down 40 to 60%. And I was like, holy crap, how can you sleep at night? I wouldn't be able to. So long story short, we're not pleased because the end result was a negative, but given the fact that this was probably one of the worst markets we've ever seen and only be down 8, that's good. That's really good. I mean, when Jason and I went to Dallas, and Keith McCullough, the CEO of Hedgeye, basically said, if you guys are only down 10 to 15% this year, pat yourself on the back because everything's been a landmine.
Perfect. Jason, you have anything you want to add to that?
No, I think John covered it. Yeah, I think he did a good job.
I would agree with that. So Richard, threw in a couple questions here. So I think we'll start with this first one regarding crypto. So it's asking, what is Forecast doing with cryptocurrency? And since you guys did the podcast, Jason, I think this is right up your alley here.
We're shorting the living snot out of it. You'll notice in your account you have BITI. That's a way for us to go short Bitcoin. The other ways we're shorting it is through a bank called Silvergate Bank. And we are most likely going to go short another company called SBNY. Both of these banks have increased in value drastically over the last decade because they took it upon themselves to be the crypto bank that really banks all of the large crypto exchanges in the world. And, to give you an example, Silvergate started in California in the early 2000s. They were in the millions, maybe, tens of millions of dollars in deposits. By the time, at the peak of the crypto craze, they were in tens of billions of dollars in deposits. The problem occurs when each one of these banks have a independent blockchain system. And that blockchain system is what is getting both of these banks into hot water. And Silvergate, in particular, allowed FTX to take client funds and use those client funds for Alameda's purposes for loans. And you cannot commingle individual client funds as your own and use them for whatever you want. And so SI or Silvergate is in deep, deep hot water. And we are short them for that specific reason. FTX was their largest client. And now that FTX is no client, they've had to sell off a lot of their assets. I think 800 million at one point. They had to get loans to keep them afloat. Now you have SBNY, which is another bank, and SBNY, in my estimation, is going to be worse than SI due to the individual clients that they have. And Binance is one of them that SBNY has, but SI does not. And Binance is a wholly fraudulent beast, bigger than FTX, and doing some things that are certainly fraudulent in the United States and fraudulent in other countries. And what I think is probably going to happen with Binance is going to get regulated out of the U.S. market. You're not going to see Binance anymore. If you have money in Binance, get it out immediately, not tomorrow, today. Get it out. So that's how we're dealing with it. Bitcoin short, SI short, SBNY short.
And Richard, if you watched the podcast we did last Friday in that Pete Santilli show, you'll be shocked at how much information we provided those guys as to what's going on with crypto. Crypto is a Ponzi scheme. It's that simple. It's all pretty much going to go to zero, is our guess. Bitcoin may survive. Ethereum, maybe. I don't know. But it's a Ponzi for the most part.
Perfect. So let's go on to question number 2, kind of regarding Congress and not raising the national debt limit and so forth. So what are we doing, if anything, to prepare for this upcoming crisis if Congress doesn't raise the national debt limit?
Okay, I'll take that one. So, Richard, you asked what happened to the market the last time Congress was kind of playing these national debt limit games. I remember that. Gold went parabolic. Gold really had a good run. Maybe that's another reason why gold's doing well. Usually that whole debt ceiling is a charade that Congress, that politicians play to make believe that they're trying to manage their spending and they're being, good stewards of capital. It's all bullshit. Okay. This time, so most of the time when you get to these debt limits, it's a total waste of time. They always pass to the last minute and life goes on because both sides of the house love spending money, right? Our money. This time around, everybody's expecting the same thing to happen, and it could be different. This time around, the Republicans may want to make some kind of a statement. So if that were to happen, Richard, and they don't approve it, and they let all these temporary spending buckets that they have, expire, and now now we really need to up the limit, it could get ugly. I mean, if they actually play a game, they play a game of chicken, yeah, your bond market's going to seize up, your currency is going to go straight down, your stock market's going to be in serious trouble. So what are we doing? Well, earlier I said if this thing crashed 10%, we'd probably be up 5%. We're ready for it. I mean, the data will tell us if that risk is increasing, and in which case we'll probably get more short. We'll probably have to cover some of our dollars, buy more gold, short bonds potentially. So anyway, long answer to your question, but.
Perfect. I think, we're right about an hour here. I think this is a good last question here for both of you. And really, it's a simple one. Where could we be wrong?
Well, we may not be bearish enough, believe it or not. When I'm looking at what's going on and I compare it to 2000, 2002, and the 2008 to 2010, this thing has been incredibly slow motion in how it's progressed. But all the games being played and the severe nature of the bubbles and the massive imbalances and the massive speculation and all that, I think we're maybe not bearish enough. I mean, this thing could open wide, man. We'll see. And if the Fed stays, it continues down their path of quantitative tightening and increasing interest rates, good luck. Anybody bullish out there that's buying stuff, you can get taken out.
Hey, Michael, one last thing I'll add is that as John had mentioned earlier in the show, we were lucky enough to be asked on a number of these podcasts, and we're kind of making the rounds. I guess we made a little bit of a splash in providing maybe some data and some understanding of what's happening in the crypto market. And so we are probably going to do another few, I don't know how many, shows on Pete Santelli. And then in addition to that, John and I were just asked to do a show with Sam Bushman. And so Sam's a little bit more, he's a pretty mild-mannered guy. I talked to him a few times on the phone, and he seems just a stand-up dude. So we're going to do some crypto stuff on Sam Bushman's show as well. So we'll give everybody links to that prior. I know they're going to do a live one, and then they're going to, Sam Bushman's a little bigger, so it'll go nationally on a lot of the radio stations, which is a little scary. But anyway, we will keep you guys up to date on that, let you know when we're going to be headed on some of these shows. And anybody that would love to listen, we'd love to have you on. We'd love to have your support, and please tell whoever might be out there that you think would find of interest, forward it to them, and we'd love to have them on.
Perfect. Well, appreciate your time, you guys, everybody as well. If anything does come up, please don't hesitate to reach on out. Send this call to any family, friends, anybody that you think might be inclined to want to just talk to us regarding, our interests and what we're seeing in the market compared to what they're probably seeing as well. And with that, we'll wrap up our Q1 2023 quarterly call. Take care, everyone.
Thank you.